Hello. In this video I will show you the various types of Japanese candlestick patterns and how to use them to confirm trade entries. Japanese candlesticks can be used to show the volume of trading within any trading time frame. If you are looking at short-term trading, or binary options, you will be looking at candlesticks that show trading patterns of 1 minute, 5 minutes, 15 minutes, half an hour, etc. If you are looking at Forex or long-term trading, you should look at candlesticks that are in a 24 hours time frame, 2 days, 1 week or 1 month time frame. A candlestick shows a lifetime performance within its time frame. Each candlestick on any time frame shows the volume of trading in that particular time, from the beginning to the end of that session. In the fight between the bulls and bears, each Japanese candlestick tells you a story. As the story goes, it tells us who started off the fight, who had the best brute force, and who eventually won the session. The tug of war between the bulls and the bears in any time frame is snapshot in a Japanese candlestick. Let us visualize this analogy: Japanese candlesticks in action. If we look at the visual, we understand the following price movement in each of the Japanese candlesticks. The top of the candlestick is called the upper shadow whilst the bottom is called the lower shadow. These two positions show us how far the price shot up and how far down it sank in any time frame. Therefore, if we are looking at a 1 hour chart, the span of the top to the bottom is the price movement that occurred in 1 hour. The solid part of the body is the actual net positive or net negative movement between a currency pair or an asset. The solid part of the Japanese candlestick shows us the position where the price started and the position where it ended. The solid body shows us an entry and an exit price. If the price has risen, it is shown as a blue body. If the price has fallen from the opening price to the closing price, it shows off a solid red body. The top of the solid body on a red candlestick is the starting or entry price in that particular hour, whilst the lower solid part of the candlestick is the exit price or ending price. Alternatively, the lower part of the solid blue Japan candlestick is the entry price, also called opening price, whilst the top part of the solid body is the exit price, also called closing price. The shadows are the full price movement from the lowest to the highest peak during the time frame, in our case 1 hour. The size and shape of the Japanese candlestick tells a story about the trading nature of bulls and bears in that particular time frame. In Forex and binary trading, bulls are the aggressive traders hitting with their horns, and they are the buyers. And bulls are the protective ones, and they are the sellers. A bullish market as a buyer's market and will create an uptrend. A bearish market as a seller's market and will create a downtrend. Never for an as trance underestimate the bears. They are just as strong as the falls. This is a clash of the titans. A Japanese candlestick with a long body shows a strong activity in trading. A long red candlestick means that the bears are dominating the market. A long blue candlestick means that the buyers are stronger in it, a bullish market. Big candlesticks indicate big activity in the market. If they create a trend, this is S perfect setting for a trade. On the other hand, Japanese candlesticks with short bodies are displaying a market where buyers and sellers are equally strong, or equally sleepy. The price opens and closes at a similar price. This is a point which gives us a lot of information about the market. If the market is asleep, or dead, or inactive, we do not want to trade. If this is a tug of war between giants, we want to wait for the outbreak and cash in. Shadows which form at the top and bottom of Japanese candlesticks give us very important information about a trading timeframe or trading session. As explained earlier, the upper shadows signify how high the price rose in that specific trading session, whilst the lower shadows signify how low the price fell. Candlestick with very long shadows tell us that the price rose or fell far past the opening and closing prices. They also signify a lot of action, very much like the long candlesticks with long bodies. The difference is that whilst the candlesticks with long bodies signified that either the bears or the bulls were the net winners, in the case of long shadow candlesticks the net winner had only a marginal success. In Japanese candlesticks, long upper shadows signify that the bulls or the buyers were strong and were pitching for a higher price, but for some reason the bears still took control and lowered the price to the level they wanted. On the other hand, a long lower shadow means that although the bears or the sellers were very strong and drove the price down, but the bulls still fought with their horns until the last drop and drove the price up to the level close to where the price had originally opened. In this second part of understanding basic Japanese candlesticks, we are going to check out patterns and their significance in trading. Here is a list of strange names for different candlestick patterns which all give us some important information about the direction where a price is headed. Marubozu. Marubozu sounds like a crazy name for basic Japanese candlesticks. What it means is that there are no shadows from the bodies. This means that the price opened at one spot and rose or fell all the way to the closing price. The price movement depends on whether you are looking at a full candlestick or a red and blue candlestick. A blue Marubozu shows us that the entry price was the lower part of the body and the closing price is the higher or the top of the candlestick. This is a very bullish candlestick. A red Marubozu shows us that the entry price was the higher part of the basic Japanese candlestick body and the closing price is the lower or the bottom of the candlestick. This is a very bearish candlestick. The Marubozu candlestick shows that either the buyers or the sellers are having full control of the situation. Basic Japanese candlesticks have a variety of names depending on their shape and size. Spinning tops have long upper shadows and long lower shadows. Their bodies are very small. Their appearance is very much like a spinning top. What these basic Japanese candlesticks mean is that there is an equal fight between buyers and sellers, and as a result there is indecision in determining the price. The real body of the candlestick, whether it is red or blue, is very short. This shows that the opening and closing price are very close to each other. Therefore there has been little change in price. The fact that the shadows are so long indicates that the bulls and the bears have been fighting it out, however none of them managed to have a winning hand. Although the opening and closing price has been very close, the price had moved up and down significantly during the trading session. However, no one was a winner. If a spinning top candlestick forms during a downtrend, this usually means that the bears have got no more energy left to push the price down and a reversal could be seen soon. Alternatively, if the spinning top candlesticks forms during an uptrend, this signifies that the bulls are out of fuel and they cannot sustain the price rise. This could be a reversal to a downtrend very soon. Doji. In basic Japanese candlesticks, doji are candlesticks which have an identical open and close price, or have such a similar opening and closing price that their bodies are extremely short. A doji's body is so small that it appears to be a thin line. Similar to spinning tops, the doji are showing that there is a huge price war between buyers and sellers, but none of them have moved from their standpoint in the price tug of war. The price may move above and below the opening price, but in the end closes in the same position or very close to it. None of the traders will have managed to take control of the price and therefore the price remains at a standstill. These are examples of the four ties of doji basic Japanese candlesticks. Although you see that there is a variation from the upper and lower shadows, sometimes there is absolutely no movement. The result shows that negligible price movement. There are four types of doji. Special attention should be given to the preceding candlestick when a doji is formed. Doji could be a form of exhaustion. If the previous candlestick to a doji is a series of marubozas and long-bodied candlesticks of the same color, then it could mean that the buyers or sellers which were previously predominant, are now getting tired of holding their ground. Hence, the opposition is now ready to take control. Doji in a long red candlestick. If a doji forms after a pattern of red candlesticks which would have been pushing the price down, the buyers are now waiting in anticipation for a price breakout in their favor. It means that the sellers are very exhausted and are now weak. If the price is to continue falling, it would need a strong influx of sellers, but at this point, the sellers are maxed out. Buyers are making to get into a great price and make some money by driving the price upwards. Doji and long blue candlesticks. New sellers are breathlessly trying to keep their foothold, but their strength is fading fast. After a series of conquered candlesticks, which have pushed the price upwards, we see a tie in the form of a doji. Therefore, a reversal is almost a guaranteed. The buyers are now excited about the possibility of selling at a high enough price and making some money as the price falls. Hanging man and hammer. In basic Japanese candlesticks, the hanging man and hammer look exactly the same, but have different colors and therefore different meanings. A lot depends on the previous price movement. In both cases, the hanging man and the hammer have a very long bottom shadows but almost no top shadow. The hammer forms when there is a downtrend. It is called the hammer because it is hammering out the bottom floor of the price support level. In a market where there has been a significant downtrend, and the price has been falling, a basic Japanese candlestick which forms in the shape of a hammer signals that the bottom is near. It is very likely that after the formation of a hammer, the price will start rising again. The very long shadow beneath the short and stout body tells us that the sellers have been fighting to keep the price down, but have been losing ground. They buyers are the net winners, but they have only gained very little in terms of price push-up. Although a hammer is a very strong indication for a reversal, this does not give a trader carte blanche to enter a buying trade. More confirmation may be required for the perfect trade setup. How does a trader confirm a reversal after a hammer candlestick formation? One typical confirmation would be to see another blue candlestick or a succession of blue candlesticks forming, and closing higher than the previous closing price. Shooting star and the inverted hammer. The shooting star and the inverted hammer Japanese candlesticks also suggest the possibility of a reversal much like the hammer and the hanging man. These candlesticks, however, work in different situations. The inverted hammer happens when a price that has been dropping shows up a possibility of a reversal. The long shadow on its upper body indicates that bulls are fighting hard to push the price higher. Although the closing price is not far from the starting price, the fact that trading was pushed so far high is a strong signal of a reversal. You must of course not assume that this will produce a definite reversal in a trend. Ideally, you get a price confirmation from a series of blue candlesticks which close at a price higher than the inverted hammer. The shooting star is a possibility of reversal on an uptrend. It is a bearish reversal and therefore will take the price down after a steady incline. The candlestick itself looks quite identical to the inverted hammer, but it happens during an uptrend. The shape tells us that the price has opened at price where it was driven quite high by the buyers, but eventually pulled back below the original entry price. It is a situation which shows that although the buyers have attempted to keep the price up, they did not manage, and although the sellers did not make a significant impact on the price, they were still the net winners. This usually indicates a reversal in an uptrend. As with the inverted hammer, a trader needs to ensure that the trend set by the shooting star candlestick is confirmed with future red candlesticks which close at a price lower than the shooting star basic Japanese candlestick itself. In this third chapter about Japanese candlestick patterns, we will be looking at how triple patterns can help us understand the direction of a trending market and when to prepare for a reversal. These Japanese candlestick patterns are strong signals which can help us set the perfect trade. Tweezer tops and bottoms Japanese candlestick patterns. When looking for the perfect trade setup, we are always searching for the right entry time. Therefore, finding a strong reversal pattern is the signal we need to pay special attention to. The tweezers are dual candlesticks which show us a reversal pattern. After an long set of candlesticks which will have set an uptrend or downtrend, spotting a pair of tweezer top or bottoms candlesticks may well signify that there is going to be a reversal in pattern. The shape of the candlesticks are literally like a pair of tweezers, and when they form, their function is to tweeze off the direction of the previous trend. Here are some characteristics that can help us spot tweezer tops and bottoms formation in Japanese candlestick patterns. The first candlestick has in the same behavior pattern as the general trend. Therefore, if it is an uptrend, then the first candlestick will also be a blue candlestick or a buyer's candlestick. The candlestick that forms immediately after the first candlestick will have the same shape but will be in the opposite Direction. If the previous candlestick was a bullish candlestick, then the subsequent one will be a bearish candlestick. The shape of the candlesticks will be almost identical. Their shadow should be of equal length. Their bodies should also have the same volume. The difference stands only that tweezer tops will have the same highs whilst the bottoms will have the same lows. Bullish and bearish engulfing candlesticks. From the visuals we can see that a bullish engulfing pattern occurs when a large red candlestick forms after a negative candlestick of lower value. The larger bullish candle is literally engulfing the previous bearish candle. This signals that the bulls are coming on strong and may see a reversal and an uptrend. Alternatively, a bearish engulfing pattern occurs when a large red candle forms after a weaker blue bullish candlestick. This bearish candle engulfs the bullish candle, which signifies that the buyers are losing their power, and it is probably time for the sellers to take over the market and reverse the trend. Morning star and evening star triple formation. This triple Japanese candlestick pattern usually forms around the end of a trend. The way they shape up could be a strong indicator that a reversal is about to happen, and this will be our setup to grab some pips or enter into a binary options trade. How will we know that an evening star or a morning star is forming? How can we use this for a trade setup? Evening star patterns form when the first candle is a strong bullish candle in a strong uptrend. The second candle which forms right after that will confirm the uptrend, but will be small and with a very short body, much the shape of the spinning top. This formation tells us that the market is getting tired and the buyers are losing their power. The third and last candlestick will be a bearish candlestick which has a long and strong body. The sellers will have taken control of the market and are ready to tear of the buyers limb by limb. The formation of the morning star is identical to the evening star but in a different trend setting. In this case, a strong bearish candlestick in a downtrend is followed by a bearish spinning top, which is then followed by a strong bullish candlestick. The trio tell us that the bears or the sellers are now exhausted and losing ground, whilst the sellers are itching to buy in at a good price and make some serious money. 3 white soldiers and 3 black crows. When 3 consecutive long candlesticks follow each other, in the opposite direction after an uptrend or a downtrend, we understand that a reversal has just occurred. This trio of Japanese candlestick patterns are strong indication. They are possibly the strongest signal to indicate a reversal in a trend, and therefore it is a perfect time for traders to make some money. 3 white soldiers, a strong Japanese candlestick patterns indicator. In this triple formation we see that this set of candlesticks form after a strong downtrend. The first candlestick is called the reversal candle. This reversal is further confirmed by the second candlestick. The second candlestick should have an even longer and stronger body than the reversal candlestick. It usually has very little or no shadow at all, implying that the buyers have taken over the market. Finally, the third candlestick forms. This should have an equally strong body and ought to be as long and strong as the second candlestick. The longer the third candlestick is, the better for a confirmation that the trend has fully reversed. This candlestick as the previous one ought to have very little in terms of shadows. This shows that the buyers are now in full control of the market. The 3 black crows are Japanese candlestick patterns, which act out the opposite situation from the 3 white soldiers. When this formation occurs after strong uptrend, we know that the dark and sinister crows will be ruling the market and a reversal has occurred which sinks the price to a new downtrend. Thank you for watching this video. Please subscribe, like, and leave a comment below if this video was helpful.